How's it going, everyone? I hope you're having a good day today. In today's video, I'm going to be going over all 13 of my holdings, all 13 stocks. I'll be rating them as a buy, sell, or hold. The market has been very choppy to start the year. Now we have fears over what's going on over in Iran, as well as with the oil prices, with the Strait of Hormuz being closed down essentially due to the war with Iran. And a lot of my holdings are getting hit. My portfolio as a whole is down around 8%, I think 7.5% on the year. So let's get started. Stock number one here is Meta. This one is down roughly 1% on the year, thanks to today's minus 2% move. This is a company that I started buying late last year, around Q3, Q4. As you can see, the stock is basically flat. We're up 8% over the past year. I've been buying ever since this dip here. After this earnings report, I started my position in the mid 600s, and that's right around where my average is, right around 650. So I'm basically flat on the holding so far. It's at 640. I might be down a couple percent. But either way, this company I obviously still think is a buy if I'm buying it at 650 a couple months later as the company has continued to compound revenue, free cash flows, earnings per share. Nothing has really changed with the story of Meta. I obviously think it's a better buy today than it was when I started my position. As you can see, let's do this on trailing 12 months. They're growing revenues around 22% over the past 12 months. And over the past 10 years, they're growing at 27% annually. The chart's beautiful. This company is a powerhouse. It's has about half of the world using one of their apps, whether WhatsApp, Instagram, or Facebook, every single day, as you can see here with the family daily active people closing in on 3.6 billion people. It's also growing close to 7% over the past year, which is incredible for their scale. And then you have things like not net income. Let's go to EPS. EPS here, this is a big dip. This is from that earnings report where you saw the big dip in share price. They had a one-time massive tax hit from the big beautiful bill that hurt EPS. This would all be up and to the right, as you can see on quarterly. Yeah, right here you see it resumed back to normal after that tax hit got out of the way. But the free cash flow, it's very choppy. This is since 2011. As you can see, we're kind of up and down. This all has to do with CapEx. As you can see, in 2022, it dropped. They had a drop in overall incomes, revenues, EPS, everything in 2022. It rebounded. Now, this decline is due to CapEx spend. They're planning on spending tens and hundreds of billions of dollars on CapEx in the coming years to build out AI capabilities. They want to be the personal super intelligence for every person on their platform. So they really see a vision with that. They think that's going to improve the quality of their marketing and advertising capabilities to their customers. So I see it as a long-term improvement to the quality of the business, despite it having a short-term hit on free cash flows. This will likely continue to go down over the next probably 2 years, maybe 1 year. It could even be up to 3 years. It really depends on how long this build-out takes. If they end up not needing all of that compute, I think the company will be able to reissue that computing power to other companies, other competitors that are definitely going to need it, as we can tell. It's one of the biggest needs in the big tech market here recently. So let's do a quick DCF for Meta. As we saw, the company's growing revenues over 20%. The free cash flow is going to be choppy short term, especially with the CapEx build out. But I do believe the company will be able to grow earnings per share. Honestly, probably closer to 20%. But for this exercise, let's just say they grow it at 15%. With the moat of this company, the scale, everything, this company's not going anywhere. I think a 25 multiple is more than reasonable for this company. Even if it trades down to a 20, we're still getting basically market-beating returns, give or take, right in line with the market. If they do end up trading at a 25, 5 years from now, you're seeing 16% compounded annual returns, which is really good. You're buying it at 640 5 years from now. If these projections were to stick, you would be able to sell the shares at 1.36 thousand per share. If this holds up to 20% EPS growth, they would probably trade at a higher multiple, probably a 28 or so. We're looking at 24% CAGR for your return, which is really impressive. Meta is obviously a buy here today. My second biggest holding is Mastercard. This company is also being hit this year, a lot more than Meta was. We're down close to 12% on the year after today's minus 1% move. And I started buying this company as well back here during this dip in November. I've wanted to own this company. I almost bought shares during the April crash. I was buying other things. I initiated a position here around 540, somewhere around this crash here. And I've been adding shares here and there. I added some during this dip. I even bought some here around 550. So my average is close to 525 on this one. I'm down on this position as well, give or take 5-10%. No big deal. I hope this company can stay down just for a little bit longer so I can continue building out a position. I have roughly a 16% allocation to this one for now. But this company is going nowhere. I think this is probably the widest moat company in my portfolio. If not this one, it's going to be S&P Global. Total Mastercards for this one. They have 3.4 billion Mastercards issued, 3.4 billion cards being swiped, 3.4 billion cards giving the company very valuable data that they can then repackage into their value-added services. As you can see here, here is their two revenue segments. Value-added services are now close to 50% of their revenues. And if it continues its pace of growth, 23% over the past 1 year, compared to the payment network, which has only grown 12% per year. If these two percentages were to keep up within 2 or 3 years, we would see this be half of the revenues. This is my favorite thing of the business. I think the company is very high quality with just the payment network. It basically holds up the national and the worldwide economy, Visa and Mastercard's rails. They basically connect the merchant and the consumer as a bridge of trust between the two. Without these two, there would be a lot less trust and a lot less transaction, especially online, holding up the market overall. So as you can tell here, free cash flow per share over the past 10 years, over the past decade, it's grown 19.2% every single year on average. Over the past 1 year, we're looking at 27%, which is phenomenal. Net income looks very similar, not as much because it's not a per share metric, but EPS a lot closer, 19% per year, 17% over the past decade. Phenomenal. Balance sheet is fine. We have 18 billion in debt. They had roughly 17 billion in free cash flow over the past 12 months. They could pay this off in 1 year, no big deal. Dividend chart's amazing for any dividend growth investors out there. Definitely recommend you checking this one out, as they have grown dividends 16.6% over the past 10 years. They're eating away shares with the buyback, buying back over 2% of the float every single year for the past decade. I expect this to continue into the future. They have a buyback plan in place. Let's look at, I have to put this on quarterly. Let's look at the return on capital employed for this company, nearing 61%, which is unheard of. You have operating margins of 61% as well. Insane. Profit margins, 46. Gross margins are, I'm not sure what this is about. Profit margins are around the high 70s. Let's do a DCF here on Mastercard. Over the past 10 years, they've grown free cash flow per share over 20%. I expect this to be very similar in the future. Let's say, for instance, it slows down. I think it could even outpace 20% with the implementation of value-added services, very high margin revenues, very low cost to produce those revenues. But let's say we just get 15% free cash flow per share growth for the next 5 years. And with the quality of this company, with the size of its moat, the rate of its growth overall, it should trade around a 3. But let's say we traded at 3.5. You're looking at 17% returns over the next 5 years. Let's say the bull case does hit. They get 22% per year growth. And we see this one trade down to a 2.8. This is very reasonable. It looks a little steep. They've done this in the past. They've traded lower than a 2.8 multiple. In the past, you get around 30% returns. Shares are being sold at $500 per share now. And 5 years from now, if these projections were to hit, we would have shares selling for 1.8K on the market. And you could buy in today at $900 per share to get a 15% return. Pretty incredible. For me, this is a very strong buy given the width of the moat and the rate of growth that I expect for the company in the future. This is arguably my top pick going forward. Going over to the third stock in my portfolio, we have Adobe. This is everyone's least favorite stock right now. This one's crushed. Down 20% on the year. I believe it's down a good chunk today. Yes, another 1% move. They report earnings tonight after the bell. Over the past year, we're seeing the stock down 28%. Over the past 5 years, 5 years ago, they were selling shares for $447. In 2021, at the peak in November 2021, it was close to $700 per share. Today, you can buy shares for $270. In that same time, you've seen revenues jump up from $14.39 billion in 2021 up to $23 billion. So it's roughly a double, a little less than a double. Either way, very rapid growth, as well as free cash flow per share has grown at an astounding 23.2% over the past 2 years, 31.5% over the past 1 year, 5 years ago, it was $13.77 per share. Last year, or over the last 12 months, it was $23 per share. Again, close to another double up. Earnings per share, very similar here over the past 5 years. Over the past 2 years, we're looking at 19% growth. Past 1 year, we're looking at 35% growth. 5 years ago, it was $11.54 per share. The last 12 months, it was $16.71 per share. The company's going up and to the right. The narrative is going down. The valuation is simply the only thing that's going down on this one. Let's do it on our price to earnings over the past 5 years. As you can see here at the peak, it was trading at a 65 trailing price to earnings. Today, you can buy the company for a 16 price to earnings. So the valuation has been chopped basically in 1/4, down 25%. In the meantime, shares outstanding are plummeting. Over the past 1 year, they reduced the float by 6%. That's insane. They plan on doing even more buybacks. And I promise you, they are probably the biggest buyer in the market right now of Adobe stock. They are continuing to spend more on buybacks than they're returning to the business in free cash flow per year. As you can see, the debt levels are rising. It's now basically even with cash. They still have plenty of room. They could do some leveraged buybacks up to roughly 10 billion in debt. I think that would be no problem at all. You can see here the return of capital. Just look at this. The share prices got cheaper and cheaper, and they just continue to buy more and more shares back. Company and management thinks this is a very, very strong buy. I do as well. You're getting it at a 7% free cash flow yield after dilution. Let's look at the historical multiple on this one. We'll do it for 10 years. It often trades down here in the 2s, 3s, sometimes the 4s. Here in 2022, during another significant dip, you got to buy it in the 5s. Let's do a DCF here on Adobe. We're going to do this one on free cash flow. So revenues have been growing over 10% over the past 2 or 3 years. I expect this to continue. Let's say it drops down to 8%. And with the added buyback, with margins staying stable, I believe we'll be able to, if they buy back 6% of the stock per year, which they have over the past year, combined with 8% growth of free cash flow, we're looking close to 14%, not 41, 14% free cash flow per share growth rate over the next 5 years per year. With 14% growth, a company like this, a monopoly with a very wide moat, you should see it trade no lower than a 4% free cash flow yield. That gives us a 27.5% compound annual growth rate. Shares will be roughly $900 per share in 5 years' time if these projections hit. I think if they have the ability to flex some more pricing power as well as maintaining their market position with the advancements of AI within their software, we could see up to 17, 18% free cash flow per share growth. And let's say the market gets over the AI fears, it trades it back up to a very reasonable 3.5 yield for the quality of the company, very high margins, very, very sticky business, 34.4% CAGR. I know it looks insane. This is probably, you should never shoot for 34% returns, but I honestly think you could get that with Adobe. There are some risks. I think the biggest risks to the company are Canva and Figma. You have other risks such as AI. People think AI.com or something is going to take over Adobe's enterprise suite of tools, as well as you have the seat dilution case. I think those are all reasonable fears, but I think the quality of the company, combined with their high margins and pricing power, this company will be just fine. This one's an obvious buy today for me. Moving on to my fourth biggest holding, this is Google. This one's around a 10% holding for me in my portfolio. I'm up big on this one. This is my longest held stock. I bought this one back in 2023. I believe around 150 per share. Sorry, not 150, 125 per share. Somewhere around here. I think it was in June of 2023 I bought my very first share of Google. I've continued to add more. I bought some in 2024. I bought a lot in 2025 after we saw where's it at? Right here. I bought shares at 150, 160, 170, 180, 190. I even added some shares after this dip here from 250 down to 240. I saw the risk go away from the company. I thought that was a great time to pile in. Now the shares are trading at $300 per share. I'm up huge on this position, especially as much as I allocated into the position last year. I did end up trimming. I had 24 total shares of Google. I ended up selling off 7. I had 7 in my Roth IRA. I moved those earlier this year. Almost at the peak, I sold them around $340 per share. As you can see, the all-time high is at $340, $369. Very lucky there for me. I saw the valuation start to run away. I saw some other opportunities in the market. So I took the win, and I still hold, like I said, roughly 17 shares of the company. Let's look at the history. The revenue over the past 10 years has grown at 18.3%. Past 1 year, we're seeing it accelerate from 2 years ago from 14.5 to 15%. So many things going. They're a monopoly in search. You have YouTube. That's basically a monopoly. No one can replace YouTube. They have Google Cloud, one of 3 big players combined with Microsoft and AWS. Very fast growth in Google Cloud within the margins and the revenue, as well as you have some other bets like Waymo, other things like that, and their subscriptions, YouTube TV. Very strong balance sheet on the company, a lot more cash than debt. Earnings per share, beautiful chart here. As you can see, over the past 1 year, we've seen earnings per share grow over 34%. Over the past 10 years, it's compounded at 25% annually. Free cash flow per share, past 1 year, it's roughly flat, but free cash flows are choppy, especially with their CapEx spend, similar to Meta. But over the past 10 years, you've seen almost 18% growth in the free cash flow per share. I expect a number similar to this to happen. Honestly, it could even be faster after they slow down on CapEx eventually. I'm more looking at the earnings on this company just because the CapEx has gotten so heavy. They're even buying back some shares. As you can see, over the past 10 years, they've reduced the float by 1.3% per year on average, and they're continuing to do so. Return on capital, they did issue a dividend in 2024. Yes, late 2024, they did begin paying out a dividend, and they constantly are buying back shares. But the fear of this one is the CapEx spend again. This one hasn't sold off much. This is one of the crown jewels in the market recently. So let's do a DCF. For Google here, we're going to do this one on earnings per share. As we saw, it's grown over 30% over the past year. I think this one could continue to grow around 20%. Let's do our bear case. Let's say it grows at 18%. The moat of this company, everyone knows Google. I mean, it's such a wide moat within search. YouTube has such a wide moat. You have Google Cloud, really high quality business. The barriers to entry with Google Cloud are insane. The need for Google Cloud is continuing to grow as every year and every quarter passes. I think this one deserves a 25 multiple all day. So a lot of people are selling out of this one due to the valuation just running up, up, up. I think all it is was the valuation catching up with the fundamentals. The company was way too cheap last year. Now, I think it's almost a buy. I'm going to call it a hold, especially for me personally. But if you really like Google, I think it's one of the best companies in the whole world. If you really like Google and you don't have a position today, you'll do just fine with this one over the long term. This is market-beating returns for me, and I think we could even see something closer to a 25 earnings per share growth and a 30p multiple, and you get 25% returns. So I'm not exiting my Google position. I did my trim. I'm probably not going to sell another share until it gets over $400 per share, and that's if it does it soon. I plan on letting this one compound for the time being. I'll call it a hold, but if you want to buy this one, be my guest. Stock number 5 in my portfolio is S&P Global. This is another company that I have recently bought into. I really wanted to buy this company for a long time. I've loved the moat. I love the index business. I really like MSCI as well, but the ratings business is just as high quality, and I wanted a little bit of both. So instead of buying Moody's and MSCI, I went with S&P Global. It gets a little lower multiple too, which is nice. But over the past year, this one's down 12.3%. Year to date, it's down 18%. Today, it's almost a 2% drop. As you can tell, revenues, look at the compounding on this one. Since 1985, it's just up and to the right, almost permanently. Here in 2013, you had a big dip, but the overall trend here is up and to the right for revenues. Over the past 10 years, it's grown at 11%. Past 1 year, a little slow, 8%, 2 years, 11% as well. So this one's going to continue to grow. Here's all their segments. They are spinning off the mobility business, so I won't even look at that one. But as you can see here, without the mobility business over the past 5 years, revenues have grown by 13%. Very impressive for the size of the moat of this company. This company, I would buy it, honestly, at like a 2.5% free cash flow yield after dilution, and I'm getting it over 4%. So I really think this is a great buy. I'm sorry, it seems like every company's a buy, but I am holding these companies, and I have been buying into these companies a lot recently for a reason. I think this transition into a lot more slow-growing, honestly narrower moat, but they are defensive. They're hiding away from AI as well as crude oil, all the craziness within the market. So I kind of get it, but over the past 10 years, this is fake. Don't look at this because we were dealing with this dip here. But over the past 2 years, you're seeing 26%. Honestly, all of these numbers here are flawed because of the ebbs and flows of the free cash flow per share. But you see the trend over time. It's up and to the right. It's very fast. Earnings per share. This paints a little better picture for us. As you can see here, if you go back 10 years again, where are we at? Q4. Okay, nice. So it's from here. Not bad. So 13%, that's very reasonable here. I think we'll see something similar to that in the future. One worry I have with the company is the debt to cash. They basically have 11 billion in debt more than cash. But with that being said, they did produce 5.5 billion in free cash flow over the past year, so they could pay this off in roughly 2 years, a little more than 2 years. This is a really incredible company. They are also buying back shares. As you can see here, they did have a big acquisition, so that's why you have the big spike here. But before that and after that, they're just constantly buying back shares over the past 2 years. They bought back 2.2% of the float over the past 1 year, a little over 3%. And they plan on doing that. The management has stated that they plan to continue reissuing free cash flow back to the shareholders. Roughly 85% of all free cash flows going forward plan to be paid back via dividends or buybacks. As you can see here, repeatedly buying back shares and paying out dividends. A great dividend grower as well. Look at that chart. Incredible. 11% growth per year over the past decade. And let's pull up the valuation. This is what's really changed within the company. Not much has changed in the story. A little bit of AI fears. You had this big dip due to the AI fears. I don't think AI has any chance of displacing S&P Global's moat. It's one of the most important companies in the whole market and the whole world, personally. But we're seeing it trade down to reasonable levels. We're now getting it close to a 30 price to earnings trailing. We had an opportunity to buy it at 25-ish, 24, 23 even here in 2022, a great buying opportunity. Here in 2023, it traded up to a 55 price to earnings. With the size of the moat, with how long I think this company will be around, in my recent video of stocks to buy and hold, S&P Global was one of the ones I mentioned. I think this company will be here for probably 50 plus years, constantly growing with that as well. So let's do a DCF here on S&P Global. We will do this one on cash flow as well. With the given buyback, 2, 3, 4% per year, I think they'll easily be able to grow at 8% free cash flow plus with the buyback. So we'll say 12% free cash flow per share growth. With the size of the moat, how long this company is going to be around, not 33.5, 3.5 free cash flow yield. I think this is very fair. This usually trades down to a 2.3 or a 2.5, something like this. So with slow growth for the company, historically speaking, and a good multiple of, let's go back to 3.5. We see a 16.6% return over the next 5 years. I feel like this company is very, very, very low downside. So I'll gladly take the 16% upside here with this one. This is very fantastic compounding. If I could get this with all of my holdings combined for the next 10, 20, 30 years, I would be more than happy with that. So I'm being able to buy these today at $4.21 per share. In 5 years, I expect it to be around $900 to $1,000 for each share. I think this is another good buy for you guys out there. Definitely put it on the watch list. Next up here is Spotify, another company. This is a company that I just bought into. I was talking about Google, how I sold out of some shares roughly a month ago. This is a company that I bought. As you can see, over the past 1 year, company's down 5%. Year to date, it's down 12%. Over the past 6 months, it's crushed, down 27%. I love this company. I love the product. I started buying back shares here during this dip. I bought it, I think my average is around 440. So I bought some here, I think at 460. I bought another share or two around 410, 415. And since then, the share prices have jumped up. I was up around 20% here at 560. I'm still up around 12% at 512. Within like a month's time, very happy with the move so far. I expect further growth in the future. As we can see here, revenue, past 5 years, you're looking at 17% growth per year. Very impressive. Let's look at their monthly active users. Over the past 5 years, it's up 17% per year. Very impressive. It is slowing down. I expect this to stay around 10, 12, 13%. They still have a lot of market to consume. They have 751 total monthly active users. I think there's a lot more people in the world than 750 million that would like to have the best music listening, podcast listening platform on their phone. I think they will continue. I think this will be probably close to 2 billion, maybe more in the future one day. I don't think that's a hot take either. Very nice balance sheet on the company, 11 billion in cash. So even though you're paying 105 billion for the company, you have 11 billion in cash with basically no debt, 500 million in debt. So you're paying, give or take, $96 billion for this company. That's doing 20 billion in revenue with solid margins. Profit margins are now up to 26%. The profitability of the company has skyrocketed recently. As you can see here on the free cash flow, it was almost nothing for a long time. It went down to near zero in 2023, and then boom, they hit profitability. They started flexing their pricing power. They had a price increase, give or take 2 or 3 months ago, right around the new year. Same with earnings, as you can see here. Negative, 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 negative. Boom, they hit profitability. I expect this to go up. Margins will continue to go up. Revenues will continue to go up. We will do this one on cash flow as well. Let's do a DCF. I expect revenues to grow roughly around 10, 12%. Let's say 10%. And I expect a little bit of margin increases. So let's say we see 15% per share growth and a 4% yield. I think this will probably trade closer to a 3.5. So this is probably more realistic. This is on the low end of the free cash flow per share growth. This could be 25%, give or take. For conservative cases, we'll do 15, and we'll say it trades at a 4. You're looking at roughly market returns, 9, 10%. I do think after the slight run-up, this is a company that's not going to perform as well. It's still a good buy nonetheless. I'm still glad to buy shares here if I didn't have other opportunities, but you're buying it today at $5.13. I think 5 years from now, it will be over $800 per share unless something happens. This one's safe from AI. This is a software company I do not think you have to worry about AI with at all. Very sticky product. The consumers love it, and that's something I love about a business. If the consumers are happy to pay the price, I think they're going to be able to continue flexing pricing power. I know a lot of people, all of my friends, my family members, if Spotify was $5, $10 more than it is today, they would still gladly pay for it. So I think this one, I'm going to call it a hold, but I think if you wanted to buy into the company long-term, you will be very fine on this one. Stock number 7, Duolingo, everyone's favorite company. Down another 4% today. I think it goes down roughly 5% every day for the past year. As you can see here, 1 year ago was at $272. It's now trading under $100. At the peak here, it neared $600, $540. So it's been chopped by like 82, 83% from its highs just last year in May, which is insane. In the meantime, as you can see, over the past 1 year, revenues are up 40%. Over the past 5 years, they're up 45% per year, which is incredible. Keep in mind, this company's trading at a 32.4 PE and a 5.3% trailing free cash flow yield after dilution. Incredible. Subscription revenue, over the past 1 year, it's up 44%. Over the past 5 years, it's up 50% per year. Daily active users, over the past 1 year, it's up 30%. Over the past 2 years, it's up 40%, and they're at 52.7 million. The company expects to be at 100 million or more daily active users by 2028. But here is the kicker. This is what everyone's worried about, the monthly active users. These are basically, if you've ever used Duolingo, you likely use it often. I go back and forth with it. I'll play it for a week or two, and then I won't play it for a while. It's very gamified. It's a learning app. I use it for chess, actually. But I have dabbled with the Spanish before. But the monthly active users are basically the people trying it out combined with the daily active users. So they had 52.7 daily active users. That's nearly half of the total monthly active users. So they have about 80 million people that are basically dabbling with Duolingo, not using it every day. They're basically free users. But these are what you convert eventually into the daily active users and the subscription users. So after Wall Street sees a dip here, but the same thing happened here in Q2. So they're very selective. This combined with the AI fears for software, everyone thinks that Duolingo is going to be no more. Why would you use Duolingo and pay, for Super Duolingo when you could simply use ChatGPT to learn a language, to learn chess, all this stuff? I think they have it all wrong. I think the moat is keeping people engaged. The number one difficulty in learning a new language is staying engaged. If you're just reading a textbook, if you're just engaging with a chatbot, I don't see you sticking with it very long. I think the addictiveness, the gamified version, the streak, everything like that, combined with the AI capabilities that the company will be allowed to use their scale and use the data that they already have from teaching and learning to implement that with AI to be even more personalized, I think the company will do great over time. These fluctuations have a lot to do with what the company is doing on the backside. Everything else with the company is phenomenal. Free cash flow per share over the past 5 years is up 80.7%. Past 1 year, up 40%, 2 years, 56%. We're not going to see this. We're not going to see these numbers going forward. But we will see very fast growth, I think. Look at the balance sheet, 1.4 billion in cash. So you're paying 3.5 billion for this company. They're doing $1 billion in revenue. Let's do a DCF here. So for free cash flow per share, I expect to see continued margin expansion. They expect to see 100 million daily active users by 2028. That's 3 years. That gives them a roughly 24% growth in daily active users, which means they'll probably see 25% in their subscriptions, which expects probably 25%, give or take, in the revenues. So if we see some margin expansion combined with 25% growth that the management gave us in the last earnings report, I expect 30% free cash flow per share growth. I really do. I think this is the highest upside shot that I have in my portfolio. If you see growth like this, honestly, you should trade at a 2.5. But let's say people are still scared of AI. They're going to give it some respect if it grows at 30% for 5 years. So let's say it trades at a 3% free cash flow yield. 58% returns per year. This is unreal. You could pay $471 per share and get 15% returns, which is what I did. I started buying shares at $200. It kept dipping, bought at 150, bought at 125, bought at 100. I bought the day after the last earnings at $90 per share. So my average is roughly, I think it's around 140 now. So I am down pretty big on the position, like 35, 40%, give or take. But I'm not worried long term. I think this is a huge winner. There is risk. It's not the super, super wide moat company like a Google, like a Mastercard, like an S&P Global. But I do see they have an 85% market share. They're basically a monopoly in language learning apps. They do have a very addictive, very data-centric approach at teaching. And I think this will continue to be enhanced with implementations of AI going forward. I think this is a big winner. But with that being said, I do hold it as roughly a 5% position. So I'm not too worried. If this one continues to underperform, it's not the end of the world, but I am definitely willing to take this upside shot. Let's say if we get 15% free cash flow per share growth and it trades at a 4.5 free cash flow yield, I still crush the market. So this is a very strong buy. If you're not confident in the company, if you don't think it's going to do well in the company, maybe it's not for you. But I think if you do like the company as an investment, don't let the market tell you what's a good buy. Just buy the stock price being hammered. If you like the company at $200, $300, you should definitely like it here under 100. This is a strong buy. Next company is Toast. This is another little niche company similar to Duolingo. I really like this one. Hit again pretty hard today. Rough day in the market today. A lot of crude oil, some short-term fear going on with the war in Iran. These always blow over. But long-term Toast, love the company. Stock has been crushed. Past 1 year down 14%. From 33 down to 29, 28. We saw it dip down to $25 here. I started buying the company last year around here in the mid 30s, and I continue to add here. My share price is close to $30, $31 I think is my average to be exact. I really like the company. Look at the revenues here. Over the past 5 years, you've seen 50% per year. Past 1 year, 24%. We're not going to see this. Obviously, they're starting to hit market. They are now the leading shareholder in their market, which is restaurant, point of service, as well as software. They are the leading leader in the market. They're continuing to take market share. I think they'll continue to do the same thing. This is probably why I like the company the most. I like that they're not trying to, like a for example, or any other POS system. They're trying to take market share in all of these. It's a very, very difficult market to control, to be dominant in. It's very competitive. If you were to take the whole market share, you would simply have very low margins. But Toast is sticking to restaurants. They're providing the best value to customers. They're sticking to one thing so they can master it. They can continue to refine the product, continue to refine the software, continue to add new features and new implementations to the software and the POS system to make it the one fits all for all small to medium-sized restaurants. And their plan long-term is to let their small and medium-sized restaurants continue to succeed and eventually turn into very large customers. They do have some large customers. I believe in the last quarter, I can't remember the name of the restaurant, but they had roughly 1,000 locations. They got a new bid for that one, so that's a huge win. The company's in great shape. Like I said, $16.5 billion is what you're paying for the company. $2 billion in cash. Love to see it. Fast growth. Free cash flow per share. It's up almost 100% over the past 12 months. Up 150% over the past 2 years. This is not going to continue to happen. But as you can see, this is what happens when companies, they're losing money for years and years and years. boom, they hit profitability. So, and that's why you see some dilution here. As you can see, a couple rounds of dilution. I don't think they'll need to do this for very long, especially given the healthiness of the balance sheet here. Basically zero debt, $2 billion in cash. They can do a lot with that. And even recently, as you can see here, they started buying back some shares to, take back some of the dilution. So if they can continue to buy back shares, continue to grow, continue to provide the best software in their market, they'll continue to see growth, probably above 20% per share going forward. So let's do a DCF on Toast. We will do it on free cash flow. I expect on the low end, especially considering they're starting to buy back shares. Let's say we see, with margins expanding, revenue growing 20+% per year, let's say we see just 25% free cash flow per share growth. 25% grower should trade around a 3, probably even lower, probably a 2.5. Let's say 2.8. With that being said, you get around a 16% returns. If anything happens, if we see margins expand even more, they see revenue grow even more, they see more efficiencies inside the business, we get 30% growth, we trade at a 2.5. Very, very sticky business. Once you're in the system, you're probably not going to switch out. High switching cost, high network effects within Toast. 23.5% returns, compound annual growth rate. You can buy shares now at $28. 5 years from now, that would leave them around $80. Let's say that, it doesn't go as smooth. You get 24% returns, free cash flow per share growth, and it trades at a 3. You still beat the market here. I think this is very, very reasonable. Let's say they begin to lose market share. This is the scenario here with Toast, and we see 15% free cash flow per share growth, and it trades to a 4. You basically have a flat investment. I think this is possible. I don't think it's going to happen, though. I really like their market position. I love owning companies that are the biggest in their market, which Toast is the biggest POS system within restaurants, and they are growing market share actively. So I really like the position with this one. I like the moat. I like the direction, and I like the growth that Toast has carved out for themselves. That being said, I'm going to give Toast a buy rating. Next up, everyone's favorite company, PayPal. This is the clown of the stock market. If you're a PayPal shareholder, you're one of the dumbest people in the world. I am one of those people. As you can see here, look at this company. Look at this stock chart here. 2021, it was $300 per share. Down to $45 per share. It dropped to 40. I think it dropped to 39 actually. It did, 39.08. So you could pay $300 for a stock, and in 5 years, it could be worth 1/6 of that, less than 1/6 of that. Incredible. Obviously, the company was so overvalued here. 2021 was a crazy year for the market. It was like a bubble, basically. Let's see what the valuation looked like back then. Price to earnings of 72. Doesn't seem very reasonable. Oh, sorry. Price to earnings of 75 at the peak. Today, you're paying a 8 price to earnings. Much more realistic. Free cash flow yield. Look at this. 13% free cash flow yield. It got as low as like a 1.3, 1.32 here. Unreal. The company was so undervalued, so overvalued. Now I think it's so undervalued. It's crazy how it turns. But if you go back 5 years ago, the company had such a bright future because sentiment follows sentiment follows share price. When stocks are going up, everyone thinks, everything's right with this company. Everything's going to be rainbows and butterflies in the future. And when the share price goes down, everything's wrong. The company's going to zero. They're filing for bankruptcy. They're going to be out of business within 2 years. All this blah, 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 blah. I think this is all overblown. $42 billion company. Balance sheet's fine. A little bit more cash than debt, so call it a wash. So you're paying $42 billion for a company with 440 million active accounts. Sure, it's not growing. It's growing 1%. Sure, it doesn't have to grow. If this business doesn't go out of business within the next coming years, all they have to do, 440 million active accounts. You're paying $42 billion for these accounts and the whole business. If they were to get $100 of free cash flow out of every single customer for the existence of the company, from here until they close doors, until they get bought out, until whatever happens in the future, 10, 20, 5 years, whenever the company's done. If they just get $100 in free cash flow out of each customer, you make money. you would get you'd get $44 billion back as a shareholder. And look what they're doing with free cash flow. Let's see here. Free cash flow, am I on? Yep. Free cash flow of the past 12 months, $5.5 billion. They returned almost $6.2 billion back to the shareholders. So they're just giving it all back to the shareholders. They did start a dividend, as you can see here. Very small one. I think it's like 1 point something percent. Oh no, less than that. 0.63% on the dividend. Look at the shares outstanding. This is the whole story here. I want the new CEO. They just got a new CEO. I want him to come in. I want him to continue to be able to provide value to the consumers, to the customers, that the 440 million active users, as well as draw in some new users at all costs. But any other expenses that they can save, any other free cash flow, I don't want them venturing off into new businesses, trying anything new, anything stupid. I don't really like the advertisements avenue that Alex Chris was going. Just pour it all back to the shareholders. No one wants to pay for the company. Give us the money back. Give it back to me. Please buy back 7%, 8%. If the share price continues to drop, buy back 10% of the company this year. If you expect to do $5 billion in free cash flow and you buy back 5% of the stock at $42 billion, if you buy back $5 billion of stock at $42 billion, you reduce the float by like 8, 9%. So, I mean, don't be dumb. The only way I think this one could go south is if they somehow go out of business within, by 2030. If they literally close doors by 2030, it's going to be a bad investment. If not, I think we will continue to see this one just get cheaper and cheaper and cheaper until eventually, since no one will ever pay for the stock, right? That's what you hear on YouTube and Twitter. They'll just continue to pay me back in dividends. So this is one that I think is a great buy. I mean, it's not the widest moat company, but it's very sticky. It has a lot of brand trust. In my small business, I see probably a quarter of total transactions done with my company still done on either PayPal or Venmo. It's very sticky. It's just too cheap to fail at this point. You're getting it at a 11% free cash flow. So let's do a DCF. Obviously, I think this is a buy. I'm not putting it as a huge holding because there is risk. But let's say they grow free cash flow at 0%. It's flat. Flat free cash flow per share growth, right? But they buy back 7% of the shares per year. So you get a 7% free cash flow per share growth rate. Now, the question is, what will the market pay for that? A 7% grower should trade roughly at a 5% yield. That being said, you get a 30% return in the share price. But, if it stays at today's free cash flow yield, you don't get as much. If it goes to a 13, you only get the 7% return. So I think there is a world where it stays this cheap. If it does, so be it. The dividends will continue to compound. They'll continue to buy back shares. I'll continue to have a bigger stake in the company. This one's a strong buy. These are smaller positions. I can't spend too much time on them. PayPal's a strong buy. We're starting to get into the smaller positions here. This is Uber. I have it as a 4% position. I just started this one. My average share price is around 74 bucks. I bought it somewhere around here after the earnings report. Earnings report was here. I bought it around here. 74 bucks is my average. The company is very, very cheap for this growth. Past 5 years, revenues has grown 36%. Past 1 year, 18%. For cash flow, let's do it on a per share basis. They hit profitability. Obviously, you're going to see margins expand. Past 1 year, free cash flow per share is up 42%. Past 2 years, close to 70%. We're not going to see that happen in the future. Looks like a similar picture here with the EPS. They did have a one-time tax benefit. So that's why you see the very inconsistent EPS here. But I think the trend over time is going to be, up and to the right. We'll probably see it grow in line with revenues plus margin expansion. So probably around 20, 22, 24% combined with the buyback. So as you can see here, they finally started to pour money back into buybacks. Over the past 12 months, you've seen $6 billion returned in buying back shares. Past 1 year, they bought back 1.6% of the float. Let's do a DCF here on Uber. If they continue to buy back, let's say they just buy back 1% of the company per year. You look at revenue growing at, let's say on a bear case, 15%. With the some margin expansion and the buyback, we're close to 18%. 18% free cash flow grower should trade around a 4%. It really depends on what the situation is with autonomous vehicles in the future. My whole theory is they will be the one common aggregator. Everyone's going to rely on their network. If there was one player in the AV race, if Waymo was the only person to ever figure it out, I would be very worried about the company. But that being said, they still have years to go without every driver in the Uber system being autonomous. So let's say we get 18% growth, 4% yield, 30% returns over the next 5 years. Bill Ackman, this is one of his biggest holdings. He said it was egregiously underpriced at 80 bucks. It's now 73. I think this is a very strong buy. Next up is Intuit. This is also another roughly 4% position. This one's been hammered. Year to date down 30%. Past year down 24%. Close to the highs. It was at 700 bucks and it traded down to 350, so it almost got cut in half. In the meantime, you're seeing revenues grow at 17%, faster than it was the year before. Past decade, 17%. This is a monopoly. They are basically the one big shareholder within small business bookkeeping and accounting. They also have Credit Karma. They also have TurboTax. 3 really sticky businesses. They have really strong network effects. I have a video up on Intuit. I posted it a couple weeks ago on why I was buying the stock. Go check it out if you're interested in that. But the growth story for this company is insane. Past 10 years, you're seeing 24% growth in earnings per share. Past 1 year, 44%. Past 2 year, 25% per year. Incredible. Shares outstanding. They do a lot of stock-based comp, but they do buy back some shares. So the float's going down relatively, basically flat. We'll just call it flat. Lovely dividend chart for any dividend growth investors out there. Balance sheet's fine. $6 billion in debt, $3 billion in cash. They did $7 billion in free cash flow over the past 12 months. So they could pay this off in, like 1 year free cash flow very easily. The thing that's compressed with the only thing that's changed in the story really is the valuation. As you can see, the nosedive here. AI is going to kill all software companies, is what they were saying. I don't think it's going to happen. 2021, you were paying pretty much a 90 price to earnings for the company. You could have bought it here, roughly where I did. I didn't buy it at the very bottom. I bought it close to 25 price to earnings, and now it's trading at a 28. Very significant discount. Let's do a DCF here. I think we'll continue to see on the bear case. Let's say I really think AI is going to be a tailwind for the company, but let's say they do see some slowed growth over the next 5 years. Let's look at 15% free cash flow per share growth. With the mode of the company, with this growth rate, we should be trading no lower than 4% free cash flow yield. You get 21% returns over the next 5 years. This is another buy. I think this is honestly a really strong buy. I love it under 400, but under 500, it's still a great buy. Let's ramp it up. Let's do 20% growth and a 3.5 yield. This is very realistic to me. You get 30% returns per year. Love it. Got to buy into it. Next up is a 3% position here with Netflix. My second to last position here. This one got crushed. It's now up on the year to date, but with the Warner Bros. Discovery thing going on, they went from 133 per share, and it dipped down to 75-ish was the bottom. I bought shares at about 80. My average is $80 and some change. Not too bad. Really fast growth here. Total subscribers is up 7% over the past year. They don't report it, but they did report it last earnings report, so that's why it's flat and then the big spike. But still, past 1 year, 7% growth. Very impressive. Revenue, 1 year, 16%. Past 10 years, 21%. I expect this to continue to happen. Let's look at the margins here. As you can see, the margins are just exploding. They're really flexing pricing power. They were losing money for years. The balance sheet's fine. They did get the $2.8 billion as well in cash. So this will be roughly from $9 billion in cash up to $12 billion in cash. So they'll almost have a net even balance sheet. So you'll be paying $402 billion for the company. No big deal. The company's doing $45 billion in revenue with pretty high margins. The earnings per share, you're looking at the past 10 years. Look at that compounding. It was just flat forever. It looks flat, even though it's going up actually significantly there. And then just boom, streaming really took off. Earnings per share up 56% over the past decade. Past 1 year, 27%. I don't know if we'll see that pace of growth, but we will see very fast growth. Let's do a DCF for Netflix. We'll do it on earnings. Yeah, I like the 20% number I had in there. Very defensible company. People see it as recession-proof. People are going to pay for their little Netflix subscription in-house for entertainment. If things were to go south in the economy, it's one of the last things that will be cut. With that being said, they do deserve it's trading at a 36 multiple. I really think they deserve a 40 trailing. But even if it trades down to a 30, You get a 30 multiple, which is very, very low historically for this company. 20% growth. I think this is very reasonable. You get 15% returns. I loved it at 80. I think it's a good buy at Netflix. I'm going to rate this one a buy as well. Last company up here is Robinhood. I have this around a 2.5% position. This company's growing very fast. Over the past 1 year, revenues have grown by 51, almost 52%. And year to date, stock is down 34%. This stock chart follows Bitcoin a lot. So Bitcoin gets crushed, Robinhood gets crushed because they do a lot of they get a lot of revenue from Bitcoin trading, crypto trading overall. This company traded up to 152 back in October. I really wish I sold shares over the past. Let's look here. So I bought the company. I almost sniped the bottom. I got very lucky. My average is like $33 and change. So I pretty much bought it at the bottom on Liberation Day. I bought it on the 7th and the 9th of April. My average cost, like I said, is around $33. It traded up to 150. I should have taken all of my money off the table. I think this is egregiously overvalued at 150. You're getting it at a trailing PE of 35. Forward of 33, free cash flow yield of 2, almost 2% after dilution. So it's not that bad here at 75, but I do think the company has a lot of risk. It's a very competitive space. They're having to give significant discounts, significant deals out to get people onto the platform. And their whole thing is, the moat is switching cost once you're in with, a brokerage, and they're trying to make it basically a bank at this point where you have your bank account, your credit card, your investments, your crypto. Basically an all-in-one finance platform for individuals. Once a large number of individuals are on the platform, it is very difficult to imagine, lots of them leaving after they have, credit card, bank account, investments, crypto, all that under the same roof. But at the same time, in this day and age, I think digital switching cost, when it takes, like I had Robinhood a couple years ago. I changed over to Charles Schwab for whatever reason. My mom was like, hey, I think Charles Schwab is more trustworthy. I was like, okay. I spent an hour transitioning over from Robinhood to Charles Schwab. It took like 2 days for the funds to transfer, no big deal. And then I saw the deals. I changed from Charles Schwab to Robinhood because I saw it was like a 2% match, as well as you get with Robinhood Gold, you get the 3% Roth IRA match. So, and I don't do any of the trading, so I don't give Robinhood any revenue on the, crypto trading, options trading. I don't do any of that nonsense, the gambling on the site, all that stuff. That's where all of their revenue comes from, or the majority of it. So Robinhood is actually paying me to use their platform. I pay them $50 a year for Robinhood Gold. They pay me, I think it's $70 in my Roth IRA match, and they pay me interest on resting cash. So, and it's so easy to switch out of the platform now that I just don't see it having a super wide moat. It's very competitive. Companies like SoFi, a lot of other brokerages are trying and fighting for market share, even though they are very innovative, very fast growing. I just don't love the future of this company. I can't put a high multiple on it. So even if we see, and it's very hard to project out something like this for 5 years. So I could see this one grow at like 40% for 5 years, or I could see it, they lose market share. I could see it grow at 10%, and a 10% grower with decelerating growth and a narrow moat, I could see this trade down to like a 20 multiple. And at that point, you're flat. So yes, it's kind of cheap, especially if they continue to execute. But if they don't, I think a base case is probably 20%. And it trades at a 30 multiple. So this is solid returns. But I'm honestly looking to, I'm hoping this one will go back up to $100. I'd love to exit and reallocate here. I should have sold. I don't like taking short-term gains. So I was being hard-headed. I was like, by the time April comes around, it'll still be over $100, $120. No big deal. I should have sold out of this one. I'm going to put this one as a sell, honestly, just given the direction of the moat. I don't think it's super overvalued, but I just don't see a clear picture for the future of this company. That being said, I am going to put this as my only sell in the portfolio. I will likely sell out of this one this year unless we continue to see further execution and the share price stay under $100. There it is, all 13 stocks in my portfolio. I think I gave 11 buys, 1 hold, 1 sell. That's probably how your portfolio should look like. I don't plan on swapping around a lot of positions in my portfolio. I plan on picking specific compounding machines, really high quality companies, letting them compound intrinsically for years and decades over time, and continuing to hold and let them, progress up and to the right. With that being said, I will likely sell out of Robinhood, and there is a chance I sell out of Spotify if we see that one continue to run up. With that being said, that's going to be it for today. Make sure to drop a like and subscribe, and have a great rest of your day.